Good afternoon. In a market defined by price wars, Lacomer stands apart. We want to start by issuing a buy recommendation based on a 12-month target price of 57 and a 37.25% upside based on a closing price of 41.53 as of November the 5th. Our recommendation relies on three main theses. First, premium differentiation. Second, funded expansion. Third, dynamic business model. Today, we will demonstrate why the market is undervaluing this unique combination of safety and growth.
Lacomer is leading Mexico premium grocery retail. With 90 stores and a multi-format strategy, Lacomer targets medium to high-income consumers who value quality and assortment over price. This premium positioning allows Lacomer to avoid mass market price wars and maintain solid margins, avoid the growing market. On the other hand, Sumesa is standard. In operation area, the company benefits from a centralized logistics, reinforcing consumer stickiness. Together, these factors define a differentiated model.
This model is large and is still expanding. The market is valued at 2.8 trillion Mexican pesos, with a CAGR of 6.5% from 2019 to 2024. In this same period, Lacomer grew nearly double the industry CAGR. Despite this growth, the market is still fragmented, with the top main four players just holding 41% of the total market share. Consumption is supported by solid macro fundamentals. GDP increased 1.2% YOY, inflation eased to 3.6%, and Banxico has begun lowering its rates. Employment stands near 59.7 million, real wages improved with a 12% minimum wage increase, and consumer confidence levels are above pre-pandemic levels. Several structural trends are reshaping demand: premiumization, e-commerce with a growth of 44%, rising penetration of private labels, and a strong shift towards wellness and healthy-focused products. Despite all the competition, premium supermarkets can control its prices. Lacomer leads the sector with a EBITDA margin of 11.8%, outperforming its peers Walmart, Soriana, and Chedraui. Operationally, Lacomer SKUs strategy uses 15 to 35,000 SKUs, unlike its peers that have 60 to 80,000 SKUs. This mainly reinforces its efficiency strategy that are looking for affecting private labels, margins, and imports. Lacomer operates in 85% premium formats in all of its stores, outperforming all of its peers in this percentage. For our recommendation, we have three investment theses. Our first thesis is that Lacomer's premium segment strategy creates a defensible niche that drives resilient and superior profitability. This by targeting medium to high income consumers. Lacomer positions itself in a segment that values quality over price. As a result, the average ticket of Lacomer is 15% above its closest peer. Unlike mass market players, Lacomer avoids price-driven competition. This mainly to protect its margins from heavy price wars that are very common in this industry. Its formats, especially City Market and Fresco, are designed around exclusivity, quality, and customer experience. This position attracts loyal and high-income consumers that are less price-sensitive and that are looking for a very experienced instead of cheaper prices. Maintaining a premium mix and higher average ticket size, it's our first catalyst.
Moving on to our second investment thesis, self-funded expansion drives growth and is focusing on premium format. Lacomer operates with a debt-to-equity ratio of 7%, lower to its peers. There's no surprise to this because Lacomer is focusing on more cash-funded expansion, insulating them from interest rate and credit market risks. This minimized risk and self-funded expansion gives us a clear path. Lacomer is able to keep expanding. However, it is also true to mention that COVID has impacted this. For example, in 2020, this impacted just to expanding only one store. This tells us that macroeconomic and social risks may limit this expansion as well as permit delays. However, at the end of the day, Lacomer is able to keep its management targets of 4 to 6 stores year on year, and this is a key catalyst for us. If management can keep, and we expect this to do, as they move more onto premium formats, this will be a key catalyst.
Moving on to our third and last thesis, loyalty, digital, and private labels are widening the moat. Lacomer is strengthening their competitive advantage through building a powerful ecosystem, an ecosystem that is built upon three main key drivers. First, loyalty. The Moneda Naranja program is deeply embedded. It's driving almost 15% of total sales and is creating a sticky, less price-sensitive customer base. The second is Lacomer en tu Casa platform, who locks high-value customers who prioritize convenience over price. And the third and last one is high-margin private labels. Unlike its peers, who utilize private brands to produce volume rather than quality, Lacomer positions Golden Hills strategically, focusing on quality rather than low prices. And this works as a key catalyst for gross margin expansion in the premium segment.
Moving on to financial analysis, we can see that Lacomer has two main key points. First, we can see the graph above is an asset turnover graph, which tells us that 1.1x is at what Lacomer is operating right now, which means that this lower asset turnover ratio reflects the business model they are focusing on, which is a high-end margin driven with premium format. And at the other hand, we can see that the cash conversion cycle is in the industry average with 0 cash conversion cycle days, which means that despite being focusing on the premium format, Lacomer is able to fund its own operation through its suppliers without squeezing them as much as, for example, Walmex.
Clean energy is improving, but the company still lacks emission targets, certification, and full transparency. This creates long-term regulatory and financial risk. Also, weakness investor confidence. In social, the company engaged with community through social programs. In governance, the Gonzalez family 59% voting control limits minority protections. This, with also disclosure ESG, creates credibility risk and difficulty the access to ESG-aligned capital. However, the company has independent committees and a 2026 transition in C-suite that is hoping to improve their leadership. Continue improving.
Moving on to valuation, we conducted both methodologies, an intrinsic valuation and a relative valuation. The intrinsic valuation was a 10-year DCF model based on bottom-up economics, a three-statement model then, and then calculating the cash flows, discounting them at a 9.53 WACC and using a 3% terminal growth rate, which arrives us at a 25% upside just from the intrinsic valuation. On the relative valuation, we can see that Lacomer consistently is valuated as low, mispriced by the market in all the relative valuation peers applied. This gives us an upside of 49%, and when blending both valuations, we get to an upside of 37% with a target price of 57, a clear opportunity for investment.
Now moving on to risks. We have to consider different risks, but we want to make focus on three main ones. First, competition. They are not the biggest player in the game. They are under constant pressure of price cuts, and they're forced to constantly justify their premium positioning. The second is the geographic concentration, because 80% of the total sales come from the central region. And third, macroeconomic sensibility. Economic trigger down can directly hurt high ticket sizes that are promoting Lacomer's growth. So despite these risks and the
vulnerability in ESG.
Yeah, we think these three main catalysts can drive La Comer to reiterate our buy recommendation with a 12-month target price of 57 with a 37.25% upside. Thank you for your time.
Thank you for the presentation. You have very convincing arguments that give a positive thesis on La Comer, but I'm concerned about negative things that I see, which is you expect a 3% terminal growth rate when in the past 10 years the inflation has been in average 4%, so below inflation levels, and you are not accounting for any growth in terms of the economy or something. If you expect a positive outcome on La Comer, I'm surprised by that low growth. You have shrinking margins in your DCF, so that doesn't match that much with your very positive view on the company. It's not that I do not agree with that, but just a question on why are you negative on those two things?
Okay, you go to appendix, please. Evaluation. 130, please. Puedes picarle. O sea, pantalla completa. Sorry, but meanwhile we're planning the slide. We can justify our terminal growth rate use was that first, inflation rate, as you said, have been the target inflation rate for Banxico, despite it hasn't been quite that, but it's 3% plus minus 1%, let's say. And also the sustainability. In our investigation, the terminal growth rate usually for the industry is about 3%, because La Comer right now is not that mature, as it's a spin-off from its last company, but we expect that maturity, and in a 10-year DCF, it should reflect at a 30% terminal growth.
Shrinking margins?
So you assume that our DCF was shrinking margins? Or in our evaluation, we didn't shrinkage margins. No, because we are... to get to our DCF, we conducted a bottom-up methodology in which we got
going from 10.4% to 9%.
Yes, we forecasted the margins based on the maturity of the company. If the company keeps maturing, it is normal in this industry for the margins to get to a little lower and get more average of the industry.
I was wondering if you could explain the reason why you think the multiples are so much lower than the industry, and why do you suppose that is going to close that gap?
Well, we think multiples represent what the market is thinking about the company, and this gap could be closed, like I said, in a 12-month period, thanks to our three main catalysts. If you could go to the última slide, which are premium differentiation, a funded expansion, and a dynamic business model. These three catalysts, if they keep at the same pace that they are performing right now, if they keep opening stores, if they keep getting higher gross margins and having a dynamic business model with all the aspects that I mentioned, like Fresco and these programs like Monedero Naranja, and they keep performing this way, the target price is going to be attained.
Okay, let me ask you a question, not as an investor, not as an analyst, as an investor. If I were an investor, I tell you, the price of this company has been followed during the last 5 years. 5 years ago, the price of this company was 42 pesos, and now the price of the company is 40 pesos. So why do I have to believe that this is going to happen if in the last 5 years, with all the growth that you show us, the company price has not reflected all this development and all these things that you have saying to us?
To start answering these questions, and I'm sure my teammates will complement it, is that we analyzed, as we said, the risks, the ESG, and we see that La Comer in the past had, when it comes from a spin-off, so it has had some problems of the trust they have in the company. But moving on to our analysis, we see that they are trying their best to keep away from those governance problems that they have having in the past, which is a big risk that we analyze, but they are moving on to be more ESG friendly, to attract more investors. And I think the market is mispricing that and castigating that part of La Comer. But despite all that,
We also think in the slide 104, we can see the graphic of the stock, and we think that is maybe in a recession because of the transition that is going part in La Comer of the CEO. We think it is recent that in October, that La Comer announced that change. There is we highlight that this date is when the change was announced. It has a downgrade. It maybe can be a recession of that part and how the market react to the change.
also mentioning that our price is a 12-month target price in which we expect that gap to close, driving from that three main catalysts.
Also, I want to add that La Comer, in comparison to its peers, it's outperforming not as a mass market player, but as a premium segment player, and that's a key catalyst and advantage La Comer is seeing. La Comer have all of its formats in the premium segment, unlike its peers. That's one of our key drivers we saw on the evaluation and all of the presentation.
In which regions of the country do you see a space for more growth on these premium type of stores? A part of the country has no space for these kind of stores, so where do you see the openings happening?
We think that the Comer is going to Monterrey. Recently, they opened Ascendis to the logistic operations. And we can see in a moment in the slide how Monterrey isn't attend at this time. So with the new Ascendis, it could expand to that part of the north of Mexico.
In your research, you present some numbers for the different segments, like sales per meter in each of the segments and the costs per meter in each of the segments. Where do you get that information from?
So, as we said, our evaluation is a bottom-up economic unit, and we have not, we didn't get access directly to all the revenue that comes from each format, but we estimated an average based off the area of meter square sales. So, basing off of that, we can estimate an average for each, how much sales does each area of a square meter generate per format. So therefore, we can estimate the margins of each format, and if they expand with a store and hitting those 4 to 6 target expansion per year, we can estimate the growth of each format and how much revenue it will create and the margins. Thank you very much.
Thanks.